Here we are today, ladies and gentlemen, 31st of July, last day of the month, and we're here to talk today in terms of our educational elements about how do traders use stop losses. So interesting subject, an important subject, and sometimes new traders fail to maybe give it the importance that it does, but hopefully what we'll do is we'll talk about that today and give new traders just a little bit of insight into how you can do it. That's great that you can hear me. That's fabulous. Thank you. As we sort of said in the introduction, we'll talk a little bit about Monday Market Matters. We always have a little look at the news and what's going on, but we'll talk about risk management, okay, in terms of a very much broader element. But what we want to focus on is, stop losses. Why do traders use stop losses? What are the types of stop losses we can use? Why would we use them? How can we help utilize them more effectively? And why is it so important for us to build them into our trading routine? And then, as always, we'll switch across to the live markets to see how the markets are preparing to open up here for the start of the US session as we enter the start of the US trading week. Those who don't know me, my name is Paul, traded for many years, traded for funds, traded for clients. Primarily, I like to focus on FX indices and commodities for my own trading. I tend to be a trend trader for longer term trading and a reversal trader for shorter term intraday trading. But the interesting thing is that regardless of what instrument I trade, regardless of what timeline I'm looking for, whether it be a long-term trade or a shorter term intraday trade, I'm always looking to manage risk and utilize stop losses. So we will talk more about that later on. So here we are, Monday Market Matters. I appreciate some people may be joining us for the first time, and the whole idea about our webinar is that we look to start the week in the right frame, okay, as we prepare for the opening of the US market. So every Monday, 2 o'clock London time, we always look to cover a little bit about the news, what's the major news to be aware of for this week ahead. We do an education piece, which is today about stop losses. We always talk a little bit about some of the tools that you have access to in terms of platforms and tools that ActivTrades clients will have. And then we always finish with a look at the live markets as we start the kind of US session in about 21 minutes time. So let's have a little look at the news that's coming up for the week ahead. It's an interesting week because, as I said, today's the last day of the month, so that always has some sort of impact upon our order flows. Then we're going into the start of August, and generally, as a rule of thumb, after about the first week of August, trading tends to get a little bit quieter, mainly because the world and his wife are away on holiday, okay, for that particular period. That's what we see. But what it can mean is that for the first week of the month, there can be quite a lot of volatility as people are invariably either taking positions off, or they are trimming positions, or they're taking profits, or maybe they're putting hedges on to ensure that their major positions are covered whilst they're away on holiday. So, today we've had a little bit of it's a little bit of a light day, but tomorrow we start to get into kind of the sort of data that we start to see for the start of most months. Okay, so you can see that there will be interesting elements like PMIs for China. We also have the Royal Bank of Australia who will have their monetary policy meeting. Most people are expecting that for it to remain unchanged, although there might be a little bit of an outlier as a possibility of an interest rate rise of 0.25%. A lot of people will be interested to see, as always, the difference between expectation and reality there. In terms of America, yes, it has the JOLTS job opening, but what you'll see is that basically the ISM surveys, manufacturing PMI, okay, will be of interest to particularly people to look at in terms of the state of the US economy. Probably a little bit kind of closer to home, certainly for those of us in sort of UK and Western Europe, is that on Thursday what we see is invariably is the UK Bank of England's Monetary Policy Committee, and pretty much most people are already expecting a 0.25% rate rise, but the real interest will be on Mr. Bailey's comments as to whether there will be more interest rate rises, whether there will be, whether they would be of 0.25%, or whether, we will hold for some period, or whether he'll even need to do some easing. The UK is in a little bit of a delicate position at the moment. And so markets will be keen to see, what his views and comments are. As Mr. Bailey's deemed to have been, for the most part, kind of behind the drag curve, okay, on this regarding certainly in comparison to a lot of his peers. And so people will be interested to see what he's actually got to say in terms of the plan for the rest of the year. And on Friday, well, it's the first Friday of the month, isn't it? So, we will have Canadian and US employment data, which will include non-farm payrolls. That was always of interest. Okay, so people will be naturally keen to see what that happens and to see whether the kind of the data from the payrolls enables the sort of the US economy to remain in a sweet spot, namely where there is disinflation is occurring, but actually the jobs market is holding up, and also consumer confidence remains strong as well. So people will be keen to see what that happens. And as always, as I say every week, if you are a new trader, I don't expect you to be able to sort of dissect these pieces of news data coming out, okay, and be able to totally understand it. But it is incredibly important that you know when those data points are coming out, okay, when those data releases are occurring. There is an economic calendar on the ActivTrades website, and there are others elsewhere. You will also find the team of analysts at ActivTrades will put out a great deal of their own takes, okay, every single day, which are worth picking up on and taking, give you a little bit of insight into that. But as I say, it's important to know when the data is coming out, because invariably that can induce volatility. And volatility is a volatility is a wonderful thing when you're on the right side of it, but it can make for a challenging trading session if you're on the wrong side of it. All right, so it's as I said, it's important to know what this data is coming out. So now that we've looked at news, let's focus on our educational piece for today. So we try to always do a little bit of a mix of elements, some hard skills, some soft skills, but today is what might be seen as a bit of a soft skill in terms of risk management, but the longer you trade markets, the longer you'll realize how important it is for you. And at a very, well, some might say sort of very direct way, ultimately you are a trader, ladies and gentlemen. As a trader, it is your job to take risk, okay, to be accepting of risk, and therefore it is your primary job, your main job is to be able to manage risk. And what I say to new traders is the better you become at managing risk, the quicker your progression will be towards successful trader. And invariably that's what people are looking to achieve. And maybe sometimes new traders, they sort of sometimes think that they have to have the most ideal trading system, okay, the most perfect setup. And whilst that will help and traders are interested in that, ultimately it is how well you manage risk that will define the longevity and the success of your trading journey. So let's talk about it on a big picture, and then let's narrow it down into looking at stop losses in particular. So we'll talk a little bit about definitions of risk and money management, and we'll also talk about kind of two major rules, and we'll also priority talking about how within those rules we're going to be talking about how we use stop losses and how we position size our capital. Now position size and capital is it's a session all of its own, and we'll do that in the future, but primarily today we want to talk about stop losses, okay, because sometimes new traders place them incorrectly and think that because they place them incorrectly, that means that stop losses are not worth using, and that's not the correct view at all. It's just about being able to understand where to place your stop loss. And as I said, in a future session, we'll ally that with position sizing your capital so that you have a total way to sort of manage risk and operate in markets. So of course, there are lots of very different ways to define risk management, and and you can find very deep and academic routes and definitions of it. But ultimately, what we talk about really, risk management involves essentially knowing how much you're willing to risk and how much you are looking to gain at its very, very very, very basic, simplistic. And that what you'll sometimes find is that sometimes people will break it down even further into, they might look at risk management as the management of their open trading positions to avoid large losses occurring, right? And that, specifically if, let's say if you're a large institutional trader, you might have several positions open, all right? Some might be acting as hedges, some might be, just because of for clients. If you're a sales trader, some might actually be just as part of an overall portfolio. And so managing those open positions, is imperative. And then also money management. You'll hear traders talk about money management, and a very simple definition of the money management element is about setting the correct position size in relation to your overall portfolio, your overall cash position, and your overall risk tolerance. And of course, that will differ depending upon whether you are, let's say, a private retail trader trading, at home or your office, as opposed to, let's say, an institutional trader working at, whether it be a bank or a fund, etc. Those position sizes will be very different in terms of, relative and actual position, but ultimately, for what we want for new traders to recognizing that, you need to ensure that you're position sizing correctly in the first place to help you manage risk within your overall portfolio. And as I said, we'll do a specific session on money management position sizing in one of our future sessions to be able to help new traders understand it and actually how to embody it and build it into their overall trading plan. So, if we look at traders over the years and who have been, very successful, many people would know of George Soros, and people may have different views, on Mr. Soros, but ultimately he's been a very, very successful fund manager, and one of his underlying principle is, my principle is to survive first and make money afterwards, all right? And that is absolutely spot on, okay? If you listen and speak to any of the major professional traders, they will all talk about how their main principle is about managing risk first and foremost. That becomes the ultimate element. Being able to, to generate returns, generate profits, etc. That's what comes second. If you're not managing risk, well, then invariably, as I said, your longevity and success of your trader's journey will differ completely. So that's all well and good as a principle, but actually, how do we tighten that up into some rules that we can actually work by, and that we can turn into action steps? Well, one of the ones I first talk about, which links to my own previous background, many years ago in my youth as an air defender in the Air Force. The rule one is that you live to fight another day. If you're conducting rule one, living to fight another day as a trader, well then invariably that's a good starting point. All right, and that we'll go into a little bit about how do we actually do that? How do we, we might embody that rule, but actually, what does that mean? How do we actually turn that into something that we look to do? Okay, we don't particularly want to get shot down, all right, whether it be in a battle or whether it be on a trading floor or a trading position. So the first rule is we live to fight another day, and we'll turn that into an action step in a few slides' time. And a second rule, when it comes to risk management, is never ever find yourself in a trade without an exit plan. And what do I actually mean by that? Well, as I said, we'll turn that into specific elements about what we'll talk about today. But part of that is firstly about having a plan. Lots of traders are very, very keen to find their entry into a trade. As I said earlier, they'll like to focus on identifying the perfect setup, or the perfect trading method. But actually, the longer you trade, the more you'll realize is that your exits are more important. And you have to recognize, where is the exit for when when I was wrong, my trade idea was wrong, and also where is the exit for when my trade idea was right. These are the three elements: my entry, my exit when I'm wrong, and my exit when I'm right. These are the basics of a very simple trade plan. And as I said, if you're doing rule one and rule two, well, then what that allows you to do is it's the very first steps in terms of managing risk in order to be able to sort of make your trading journey a successful one. So if we have those rules, in terms of, rule 1 and rule 2, live to fight another day, never be in a trade without an exit plan. How do we actually do that? What does that mean when we're talking about actually trading on a day-to-day basis? And regardless of what instruments you look to trade, ladies and gentlemen, because I know there are people here who join us, and there's some people who like to trade FX, there's some people who like to trade crypto, some people like to indices, commodities. That's all okay. Regardless of what instruments you trade or what time frame, regardless of whether you're a 1-minute scalper or a 1 month position holder, or whether you're trading direct FX, or whether you trade contract for differences, or whether you're creating spread betting, all of which are available to ActivTrades clients, you always follow 2 simple mantras, okay? Namely that you never risk more than 1% on any one trade, and you never ever trade without stop loss. Now, the risking more than 1% on any trade, that ties into that position sizing and money management, and we'll do another particular session on that, okay, in the near future. But today, what we're going to look at is, let's focus on stop losses. All right, let's focus on what they are, where they go, why they fit in, okay, and what we actually need to be doing as traders to ensure that we utilize them correctly. So, firstly, I appreciate that there'll be some people here joining us who are very, very new to trading, okay, who are very new to the trading journey, okay, and are still getting to grasp with the most basic of concepts, and that's absolutely fine. Please never feel that alienates you in any way, shape, or form. Remember, everybody was a beginner, all right? Everybody was a beginner. Everybody started their journey, okay, without knowing too much and being able to learn. And that's what these sessions are for about, is being able to help provide a little bit of insight, a little bit of education, a little bit of just analysis of not only markets, but also analysis of, how to conduct yourself as a trader in markets. And so, when new traders are talking about a stop loss, okay, in terms of what it is, well, it's simply an order to sell an instrument at a specified price in order to limit a loss. So, as I said, this a little bit of chart it doesn't really matter what instrument it is, doesn't really matter what time frame it is. We'll talk about how our trader in particular is basically just been looking to trade this pullback. Let's say here they've identified this particular nice pin bar. It's on a pullback. They're looking to basically buy the pullback in a trend, okay, because they believe that the trend will re-exert itself, okay. In this case, it does, and so most people will recognize that as a pin bar, it's a bullish pin bar, and they will look to have an entry order, okay. They will look to have an entry order to take them into the market. But what we also need is to have an order to sell the instrument at a specified price in order to limit our loss. Now, most traders, myself included, would look, when you're utilizing price action, when you're utilizing candlesticks, will very often just effectively have a stop loss beneath the low of that particular candle, of the particular trigger candle. And that's the basic elements. We're going to share a few different ones with you here, okay, just to broaden your knowledge and experience. But as a general rule, most traders utilizing price action and start of their trading journey will have their entry order above the candlestick with their stop loss a couple of points beneath it, all right? And that will depend. How far you have it beneath it will depend upon the time scale, the spreads, okay, the sort of the size of the position that you're actually particularly looking to make. But the important thing is, whenever you look to place an entry, whenever you're looking for a setup, the important thing is, well, where does my stop loss go? Where does my entry go when I realize that this order has not worked, or this idea has failed? Because, and I'll just clear this down. What we want is, we might have an entry order here, and of course, in this particular case, we can see the trade went delightfully in our way, and we all love that when that happens. But it's particularly, we could have been entered long in our position, and then for whatever reason, price had turned down and basically started to sort of collapse completely. In which case, our entry to buy here, the idea is no longer valid. It has failed, and that happens to every trader. Okay, if that happens to you, it doesn't mean you're a terrible trader. It doesn't mean you're a bad person. It is just part of operating in a fluid, dynamic environment like financial markets. So what we want is, as I said, we want a stop loss order in place to take us out of it, to basically to limit a loss. to ensure that we are, our loss is contained. And as I said, once you get into the position sizing element, that goes into a bit more detail. But the important thing is that we have a stop loss in place to begin with. So why would we bother with them? What's the point of having protective stop losses? Well, as a trader, especially, if you're going to intraday trade, protecting yourself at all times and in every trade, it needs to become a subconscious habit. All right. You protect yourself at all times. And if you take a losing trade, a financial loss, do not take it personally. All right, it is your job as a trader to put the trade on, to put your stop loss on, okay, to put your exit on. All right, the market will define when and if you actually get paid for that particular idea. However, trading without protective stop loss orders is outright exposure to financial self-destruction, all right? And we want to be able to avoid that. And so stop loss is in order to be placed at the time of entry to take out the market when we know our idea has failed. And that, as I said, that is absolutely fine. You will find that some of the best traders have very, very small hit rates. Mr. Soros, who we saw earlier, his hit rate sometimes can be between 10 to 20%. So he's only right, 1 or 2 times out of 10. Okay, and yet he has become immeasurably successful and immeasurably wealthy off the back of being able to be right. But the thing is, what he's got in place is, even though he might be wrong 7, 8, 9 times out of 10, when he is wrong, he just loses a small portion of his trade capital. Okay, he lives to fight another day. Remember that rule one: living to fight another day. He loses a small portion, and when he is right, well, then invariably the size of that trade in terms of its profitability effectively covers all his previous losses. Now, the reality is most people don't want to trade with a 10% hit rate, okay? Most people actually want to trade with a 90% hit rate. And most people, especially I have to say men, we hate losing money and we hate being wrong. And when you trade markets, that is an experience that you will have. You will be wrong and you will lose money. Hence why traders like to point themselves towards 90% hit rate, trading methods. But the reality is, whether you have a trading method that has a 10% hit rate or a 90% hit rate, you still have to follow those two rules, okay? Those two mantras of, never trading without stop loss, never risking more than a small portion of your trade capital on any one particular trade. So when it comes to stop losses, well, there are actually multiple types. As I said just there briefly, a lot of people will just use simple price action and just place a stop loss the other side of the candle. But there are a multitude of other different types of stop losses, which we'll talk about here. And I'll give you a little bit of insight into what I use and how I particularly like to operate myself, just to sort of, give you the benefit of my experience. So, as I was saying, this is, let's get the old drawing tool up here. This is just basically, a daily chart of the Dow. And if you're a price action trader, and as we talked about, just basically looking to sort of trade pullbacks on trends, well, this is what we were experiencing. Okay, that particular period of where we had markets were in nice uptrends. It was above the 20, above the 50, above the 200 period moving average, and every time price kind of pulled back, well, there was an opportunity to sort of to buy in, okay, to basically to buy the pullback. And that's that's what we saw here, it's what we saw here, it's what we saw here, it's what we saw here. Okay, that's what you're looking, and lots of trend traders would just quite happily be looking to do that, to buy pullbacks in an uptrend. So with that in mind, as remember what I was saying, is that whenever you look to enter a market, you also need to know, well, where does my idea prove to be wrong? And so in this particular case, we might have been getting long here, but our stop loss would be just beneath the lows of the recent candles, okay? Just beneath the lows, okay? Just beneath the lows, because if the market triggers here, our order in, but then turns over and falls away, our order is no longer valid, or our idea is flawed. Okay, we don't want to do. As I said, right at the start, as a trader, your primary job is to manage risk, and the way you do that is by ensuring that you only risk small portions of your capital on the trade, and you never trade without stop loss. These are the things that allow you to, at a starting point, to be able to manage risk effectively, and by doing this, This is what helps, accelerate you towards, operating as a true disciplined, effective, and consistently successful trader, because that's what we're looking to achieve. So, as I said, when traders are using price action, it's normally quite relevant, okay, that basically the stop should just go beneath the low of either the trigger candle or the recent couple of candles as a starting point. But what we'll find is that there's actually lots of other different ways, which I'll share with you now. And part of it is about finding which is the way that suits you, okay, which is the way that you can most consistently, apply that in your own trading plan. It's not about being perfect. It's about which method appeals to me and that I can use effectively day after day in my trading style. So, we have, as I said, we have lots of different types of protective stop losses, and many of them you might have heard, maybe you won't. So lots of people will use technical analysis stops, which is a little bit like what we've just talked about there, namely just looking at how price is playing out on a chart and being able to identify areas where our trade idea would be wrong. Some people will use financial stops, and so sometimes you will find that new traders might use a financial stop, and what I mean by that is that they may determine that actually, they can only afford to risk $20, $200, $2,000 on a trade, and so their stop is defined by their financial levels, okay, which is not necessarily right, ladies and gentlemen, and we'll talk more about that in a couple of slides' time. Some people will have discretionary stops, all right, namely that they will just quite happily put their order into the position, and then we'll have a discretionary stop. They will have like a mental stop in place. My view is that is not really the smart way to operate, certainly for a new trader. What you want to do is to actually have your stop loss order on the platform at the same time as you apply your entry order. Some people, you'll find, they will have psychological stops, namely that they will just stay in a position until they can no longer stand the psychological pain. That is not a smart way of operating, ladies and gentlemen. That is not a way I would recommend anybody to do, and we'll look more at that in a moment. Some people will use volatility stops. What does that mean? Well, that's probably easier to explain in a couple of slides' time when I'll show you a bit of an example on utilizing the ATR as a means of a volatility stop. You'll find some traders and investors will use a percent stop, namely that every time price moves to a new high, they will have a let's say for often maybe a 20% level, okay, 20% level from the recent high, whereby they will actually look to exit the trade if the price drops more than, let's say, could be 15%, could be 22%, depends upon the individual's risk tolerance. Once again, I find it's more investors who use that. Personally, it's better than no stop loss, but it is not necessarily the best way. What you will find, and I use it myself, is that also some people will have time-based stops. So rather than identifying a level on the chart whereby their trade idea is no longer valid, what they might do is be looking at a time-based stop. So namely, if the trade has not achieved, the kind of the move they were looking for within a certain time window, well then they may actually look to basically just stop that particular trade. And that is, I use that myself primarily in my kind of shorter term intraday trading, all right, but more of that later. So today we'll focus on technical analysis because I think that's what is probably most useful to new traders, and it is also what you'll find most private traders, retail traders will be utilizing in their own particular trading style. So, as I said, there are many different types of stop loss trading you use. The important thing to realize is that there is no perfection. Okay, just because you put a stop loss on doesn't mean that you will, you will not have be stopped out. Okay, every trader gets stopped out. Okay, every trader gets stopped out. There is no perfection. What is perfect is finding a way and method to place your stop loss that you can do consistently, trade after trade after trade, after 10 trades, 20 trades, 50 trades, 200 trades. That is actually where the perfection is. So what I always suggest is just use a simple one that you can understand, that you can comprehend, and that you can basically stick with time after time after time. And all it is there is to confirm that the idea you had is no longer valid, and that your job is you are managing your risk by limiting your losses. Your job as a trader is to take small losses. That's it. Your job as a trader is to take small losses. Let's have a look at a couple of different examples of different types of protective stop losses. As I said, sometimes maybe utilizing technical analysis. So one of them is actually just using the pattern itself. So if you're trading something like a flag pattern or a head and shoulders pattern or a channel or a wedge, all right, or a double top or a double bottom, you can actually use the basically the pattern that is showing up there. So this is Google on a weekly chart. Price had been in a very nice uptrend, and then it created this rather large flag pattern, but it was still a bullish flag pattern. And lots of traders will have been looking to basically to buy, to enter the trade, okay, just when it's here, because that's the very nature, okay, if you're trading a flag pattern. But then, as I said, you have to basically look at where do you place your stop loss, all right? Where do you place your stop loss? And that should go in where you have your, when you're placing your entry order. So in particular case, what you will quite often see is that aggressive traders, well, they may have had their stop loss here just under the recent price action. Other traders may have had a further away stop loss underneath the kind of the other side of the pattern. So this is a flag pattern, but it would be the same whether it would be a double top or bottom or a head and shoulders. Just you can either have it very aggressive, okay, or you can have it, the other side of the pattern. The thing with the other side of the pattern is that invariably now your trade risk is much bigger, which means that to generate the kind of reward to risk that makes the trade work, well, then you're likely to have to expect or stay with the trade longer for it to move further in your direction. And some traders will be very happy with that, others not so much. Part of this, as I said, is about understanding your own risk tolerance. But the important thing is that you're utilizing stop loss. So if you're trading patterns, the other side of the pattern is a good starting point in place of where to place your particular stop loss. Another simple sort of technical analysis one is actually just using a trend line. All right, just using a trend line. So this is silver. It's on a weekly chart, and you can see that actually over a couple of years it was just in a downtrend, in a kind of a downtrend until this sort of double bottom here. All right, okay. Traders who are trading double bottom, they may have entered here, and the stop loss will probably beneath the low, but for the sake of us, what we're doing is that, if you have been short, okay, if you're someone who is shorting silver, well, then, you may have actually just basically been recognizing that, we've had these effectively lower highs that respect the trend line. And it is only when the basically price breaks the trend line that if you were short, well, then invariably that would be where your short position would have been stopped out. Okay, now, admittedly, this is a weekly chart over several years, but price is fractal. The idea, it's a weekly chart, but it could be a 5-minute chart over a couple of hours. Okay, it's the same concept, namely that you can just draw in a very clear trend line and have your stop loss behind that trend line, and actually only when price breaks it, okay, price breaks and closes the other side of it, that is when we actually look to, in this particular case, to close your short position. So another one is a volatility stop, which is what we talked about a little bit earlier. Said I would explain it here. So what we're looking at is this is an example on the Canadian dollar against the Swiss franc. Okay, and we have a 30-minute chart, and we were actually looking to go short. We had a little bit of a triple top here with the price action, okay, giving us just a bit of a rejection candle, a bearish candle. We're looking to basically short this short this market. So we were looking for where do we place our stop loss. Now, some people, as I said, let's just clear these drawings. Many people would have just placed their stop just above the recent highs, okay, just above the recent price action. And that's absolutely valid, but some people like to utilize a very simple mechanical way to place their stop loss. And one of those ways is to use the ATR indicator, the average true range indicator for stop loss, which is available on all of the ActivTrades platforms that you can trade through. But what people will do is invariably they will understand, well, what is the average true range for that time frame I'm trading? So in this case, it was a 30-minute chart, and what we actually had was invariably the average true range on on the 30-minute chart for the Canadian dollar and Swiss franc was, I think it's around about, as it says, there's around about 9 pips. Okay, and what we do is we have a stop loss which is 2 times our average true range. So if the average true range for the 30-minute chart is 9 pips, well, our stop loss would be 18 pips, twice that average true range. And the reason we'd be doing that is because it is the average true range. So we would expect that even if there was the price came back, against us, it probably will not come back enough to basically sort of, to hit a stop loss that is 2 times the ATR. So if this, I think, is useful for if you don't have huge confidence in your price action analysis. Price action analysis is like learning a new language. The more you do it, the better you become at it, the easier it becomes to do it well. What might be an easier option for traders in terms of using a stop loss is to utilize something like the ATR indicator. And the time frame that you're trading, whether it be a daily chart, 30-minute chart here, 5-minute, 1 minute, whatever, you just actually looked at what is the average true range, and your stop loss could be double the average true range away. So if you're trading something bigger that might, maybe you're trading on the weekly chart where it might have a 200 pip average true range, well, your stop loss is going to be 400 pips away, okay, twice the average true range. So it becomes quite simple, it becomes quite mechanical, and sometimes for new traders that can actually be very beneficial, rather than having to sort of to try and understand the price market analysis. If they're new to trading, they're just able to very quickly utilize the ATR to work out what is the average range, what is twice that. That is where my stop loss goes from my entry. That's what we're looking for. So that can be, as I said, for many traders, that can be a useful way of operating. You'll find some of the big traders as well, or let's say the longer term frame traders, will actually sort of just also have their stop loss behind something like just a significant number. You'll hear me talk about BRNs, big round number. So in this particular case, okay, traders who are looking to basically to buy would have their stop loss beneath the big round number of 50. Okay, in that case, it is what they call like 3-digit, treble zeros. Okay, looking for that. Now, is that a way to operate? Yes, yes, and you will find that some of the big, let's say the older style traders, will quite happily utilize big round numbers as their stop loss position. My own view would be that if you are practicing enough at your overall price action analysis, you should be able to find a better place to place your stop loss, okay, based upon if you're buying just based upon understanding where the lows are, okay, recognizing that, and that being a place for where if you're buying, for where you could identify as a stop loss to go. But as I said, I recognize some people maybe don't have the technical analysis skills, that they're still learning, or that they just effectively just feel comfortable with big round numbers. It's quite a psychological level. And as I said, it's better than no stop loss at all, but it wouldn't be my particular favorite way of actually looking to utilize a stop loss. But as I said, I'd share quite a few different ones, okay, so that you can just see which one might be suitable for yourself. And once again, if you want to use just an indicator that can help you where to place your stop loss, well, one of the ones you can utilize is PSAR, okay, which is, as I said, once again, it's available on the ActivTrades platforms. Parabolic support and resistance, that's what it is. And hopefully you can see on this chart is that what it does is, it prints the dots, okay? So when price is in an uptrend, you'll see it will print dots beneath the trend, and alternatively, when price is in a downtrend, it will print its dots above the price action. So if, let's say, let me just clear this down. Let's say, for example, we were looking to sort of trade the breakout of this kind of particular level. Well, if we were having our breakout order here, what we'd look at is, well, where is the PSAR indicator? And our stop loss would basically be placed where the PSAR pings, okay? And every time it updates, that is where we would trail our stop loss to. So, it's, as I said, it's not perfect. Nothing is, but it is mechanical. And for some traders, having even just a mechanical stop loss is better because it removes ambiguity, it removes worry or concern about whether they are placing the right stop loss. Okay, what we can do is just basically use the PSAR and invariably just basically have that as your stop loss, and you trade it and follow that stop loss all the way up until either stop loss is hit or the PSAR flips, as you can see there, right? The likelihood is the PSAR's flipped, that you're probably already price is reversed and is taking you out anyway. But in that particular case, you might be you might be getting in there, okay, and with your original stop loss here, and then you're getting taken out here. And so in good trends, it allows you the opportunity to effectively take a piece of that trend. So once again, if you don't have much confidence in your price action, market analysis, as I said, it's a new language. All right, the more you practice it, the better you'll become. The PSAR indicator, which, as I said, is available on the ActivTrades platforms, all of them, ActivTrader, MT5, MT4, they'll all be there. You can utilize that as a simple way and means to basically ensure that you have a stop loss on place. And as what we'll probably find is that as your experience grows, as your understanding of markets, as your analysis of markets improves, well then your stop loss may change. Okay, your stop loss strategy may change, but as a starting point, utilizing something like PSAR can be a very, very simple way to do it. And and one of my own longest trading buddies, okay, who is he's a good sized trader on both oil and the EES on the S&P. He himself, even though he's been doing it for years, he still uses PSAR as his stop loss because it's simple, it's mechanical. All right, he doesn't have to do too much thinking. All he does is just basically place a stop loss at that level and just follow it until he's taken out, and that suits him. And he's been trading for 10, 15 years and is a very, very consistent, very successful trader, right? But even he does that. So as I said, if you're a new trader and you're still sort of just trying to grapple with utilizing stop losses and where to place them, well then the PSAR indicator can be a very simple way to work with that. So before we just look at the live charts, okay, just let's just sum up there, all right? So Monday Market Matters, all right. It has been an interesting year in markets already. We're already deep in now into the second half of it. So I hope you'll continue to join us, all right, as we cover lots over what I suspect will be a very interesting end to the year. With regards to what we've talked about here, as a trader, it is your job to take risks. And really that means it's your job to manage risk. And the better you become at managing risk, the better your trading journey will be. And the way you manage risk is by only risking a small portion of your capital in any one trade, and you never ever trade without stop loss. All right. There are multiple types of stop losses, which we talked about this morning. None of them are perfect, and what's really important is that you find the one that works best for you, which is the stop loss style that you can invariably commit to utilizing on every single one of your trades. Okay, stop losses are not something you just use as and when you feel like it. Stop losses have to be used from day one, and you have to basically train yourself to utilize them every day. And I make no bones about it. One of the major contributors to my own success was that from my very, very first live trade all those years ago, I utilized a stop loss there, and I've never ever taken a live position in the markets without being a stop loss in place on my platform. All right, not discretionary, okay, not psychological ones, but actual, well clearly defined stop loss level that is on the platform at the same time as I put my entry order. Right, and it's one of the things that contributes to my own success. And I know pretty much every other trader I have either traded alongside on trading floors, or I have taught, or I've coached, or I've mentored, or I've known. All of them manage risk by utilizing stop losses and by trading just small amounts of capital on their trades. Okay, and those rules I'd like you to take away from here. Anyway, let's have a little look at live markets, see what's been going on. But before we do, just remember that our next session, okay, Monday Market Matters, next Monday, London, 2 p.m. time. What we're going to talk about there is how to trade price action combinations. How lots of people will use price action analysis and candlesticks, but actually how when you combine them, you can combine 2 or 3 different price action signals, combining price action with things like indicators or other elements, stuff like that. all those combinations can come together to help you develop your own ideal trading method. So that's next Monday, London 2 p.m. I hope you'll join us for that. So if you'll just bear with us a moment, what we'll do is we'll switch across to the ActivTrades platforms. We'll have a little look for the last few minutes, see how the market's setting up for this for the week, and also for the start of this particular week. So just bear with us a moment, and we'll switch across. Okay, so I am hoping that you can still hear me. I'm hoping that you can see the charts as well. But I've got this here. I've got this on my. Let's get the old tool here. Got my US indices profile up here. For us to be able to have a little look at. And what I've got here is boom. I've got US indices, and as always, what I'm looking to, we can see the market has just been opening there. As always, what I'm interested in to do is let me just move some of these things out of the way. You can utilize better. Bang. I'm always interested to look at, where was the previous days highs and lows, and we can see that I have an indicator that does that. Those indicators are available freely for MT5, MT4. And let's just draw this out here. What I'm interested to do is I just want to also sort of just identify where were the particular, kind of highs and lows going into the opening of the market there. Okay, I'm just interested to see that in case they become particular of interest in the next sort of couple of hours. We can see that 5-minute chart here. You can see on the open, there's a real swing there on the open, and it looks like we're bullish on the down. We've already kind of tried to push our way through the sort of the high of the day so far. So we'll just keep an eye on that. Come back to that in a moment. If we look at the S&P 500, interested just to look at the same on here. Just looking at where particular lows, where particular highs. I'm just always looking at that just to see how price reacts there. That's what I'm always interested in. Just look at the fractal there and do that. Let's have a little look at the lower time frame. Well, that's kind of the 5-minute chart there. That's kind of the price action. This is why I normally miss the first sort of 15, 20 minutes. But interestingly, you can see for yourself that not only did we go up to yesterday or Friday's high, we've gone up to the high of today's session, and we've just tapped off that and fallen away. That might be interesting to watch, see if we get a reversal of that as we go into the 10 to 11 hour slot in terms of 10 to 11 at EST. Let's have a little look at NASDAQ, what's it's doing. Same thing, as I said, I'm kind of always just interested just to see where are the highs, the sessions, the recent highs and lows, just to basically identify these might be areas where price will interact with. It might give me a false breakout, it might sort of just move differently. So I'm always keen to see what's going on there. If I look at NASDAQ there, go from 5-minute chart, we can see we've had a very volatile start. We've pushed up to these high, which is yesterday's high. This is also today's high. It's also previous week's high, and it's been rejected. See that? See how that's what I'm always kind of interested in. Right, it's pushed up there, been rejected. It's the 1-minute chart, and fallen away pretty strongly from there, isn't it? You can see the wicks there, and it's dropping away. And that kind of always interests me. I think I say this every week, is that ideally I want to see all these markets move together. What we have there, I would say, is the NASDAQ went up to that area first and is dropping away. But then now we also have the Dow dropping away, and we've also had the S&P dropping away and stuff. So we've kind of bumped up, and there's been a little bit of a maneuver away from that. All right, and that's what I'd be interested. That's what I'd be interested to watch out there. And let's just clear this. Let's go back to this. I'm gonna have a little look back at this NASDAQ. Because what would be looking based upon what we were particularly looking at, there might have been traders who were waiting to sort of trade aggressively, and to short, to fade the moves. To fade the move to yesterday's highs, Friday's highs, and the previous week's highs, which we can see there. Might have been traders looking to fade that, to short that. Well, the ideal place if you were shorting there, the ideal stop loss is above where we can see prices reacted there. And that's why traders would just be placing the stop loss just above the most recent high, the most recent low. It's a sound place, okay, just to be able to realize, because let's just clear these. Just that, if we had been shorting here and our stop loss was here, if price continues its bullish move up, well then once price has moved through there, our short idea is failed, and then it's over. So it is, having a stop loss there helps us mitigate any particular losses. All right, and we'll just use this as an example. Whilst we're here, there'll be traders here who just, there might have been traders here who probably, were trading. Excuse my drawing. Trading, the kind of the breakout there. Prices here, it's breaking out. It's above the 20, above the 50. And they might have been looking to buy buy that pin bar. In which case, you stop it beneath the low. Buy that pin bar in case you stop it beneath the low. You might have tried that 3-bar reversal. Buying that, you stop beneath the low, okay, until you hit the previous day's high, where invariably we get a bearish engulfing candle, and that's kind of telling you it's finishing. So, as I said, price action it's like a language. You have to learn to it, and the way you learn it is by practicing it. And so when market in the trend, and you're looking to buy, pullbacks, well then underneath the price action is the simple place to where good traders be placing their stop losses. Or alternatively, they might be looking to utilize something like the average true range there. So we're just looking at this here. You can see that was quite some turnaround there, wasn't it, for the start of the week? Let's just get rid of that. That's quite some turnaround. Basically, you can see the price went up here on the S&P 500. Price, at the open, it bounced up to the previous high, turned around, and has just dropped there, hasn't it? Same as the Dow. Okay, same as the Nasdaq. Remember, I was saying I like to see these major indices be correlated. I don't like to see them. I don't like to be seeing one moving up, one going sideways, one going down. I like to see them all basically operating in the same direction. That kind of correlation sort of pleases me. It sort of gives me an indication that the algos are in charge, and they are running away quite happily with it. And that's what we'd be looking to do. So I'm just going to clear this up here. As soon as we look, I'll be getting ready to. I'm just going to put these onto the 1 minute charts. I'll be looking to trade these, okay, as they come down. So yeah, if we look at Dow has come down to where it's where we saw lots of this maneuver, and it's invariably there's always going to be a little bit of a reaction. So we'll just watch. I would just be watching on that, ladies and gentlemen, just to see how this does as we go into this hour, which is 10 a.m. to 11 a.m. Eastern time, okay, Eastern Standard Time. That can be when you'll see there's lots of traders intraday traders who like to operate in that area. As I said, I normally suggest the first 15 to 20 minutes, okay, of the US market open, especially on a Monday. You might want to leave just because it can be quite volatile until you start to see a pattern emerge, and this is what we're seeing. This is what we're seeing here. Okay, super. Okay, ladies and gentlemen, unfortunately we ran out of time there. As always, time flies when we're having fun. We'll try to squeeze in as much as we can. Apologies, we had a little bit of audio tech there. For some reason, a little bit of challenge there, but we got there in the end. That's the important thing. Hopefully that's giving you a little bit of insight as to, why it is important to have risk management plans, why it's important to basically never trade without stop loss, and understand there are lots of different stop losses, but it's actually none of them are perfect. It's about which one can you utilize consistently, trade after trade after trade. That is what becomes important to you. As always, I wish you the very best of success in your trading, ladies and gentlemen. I hope you'll join us next Monday, 2 o'clock, when we'll be looking at price action combinations. Until such time, trade well, everybody, and we'll speak to you soon. Cheers.